Good morning, everyone. Welcome to today's webinar on cement sector conducted by Brickworks Rating. Thank you all for joining this discussion, and we look forward to having an enriching discussion on this topic. Before we begin, let me introduce the speakers for today's webinar. We have with us Mr. Vikrant Chaturvedi, Senior Manager Research, and myself, Neeraj Rathi, Director Ratings. Now let's dive into the agenda for today's presentation. This webinar will dwell into the trends, challenges, and future prospects of India's cement sector, offering insights into how have the industry players fared over the last 4 or 5 years and the expectation in terms of their performance and financial health over FY26. Join us as we explore these aspects and their impact on the credit rating of the cement industry players. Next slide, please. The cement industry stands at a cornerstone of nation's infrastructure and development, fueling its rapid urbanization and industrial growth. As the second largest cement producer globally, the sector is integral to India's construction landscape, providing the essential raw material for projects ranging from highways, bridges, to residential complexes and commercial buildings. Looking at the strong correlation between the cement industry and the GDP growth rate in India, the industry in India is highly correlated with country's economic growth. This means that as GDP of India grows, so does the demand for cement. India's installed capacity is geographically split as it is a bulk commodity, and logistics plays an important role in determining where production capabilities are established. Facilities are established close to raw material source, which is limestone mines, as it is cost effective to transport raw material through a conveyor belt to the production facilities. South India has the highest capacity due to its raw material abundance, followed by West India. Next slide, please. Large companies, mainly the top 5 to 6 players, have a pan India presence and control more than 50% of the capacity and dominate the industry. These companies also enjoy significant pricing power relative to the smaller industry players and also have relatively better brand recall and market reach. Reflecting industry growth, top companies grew at a CAGR of 7 to 8% over the last 5 years, both in terms of production and sales. And this is in close correlation with GDP growth. With expected GDP growth rate of around 6.5 to 7% in FY26, it is safe to assume that this industry is likely to grow at a similar pace. Also, since most of the consumption happens domestically and only a small portion is exported to the neighboring countries. Next slide, please. The key demand growth uh, or demand drivers for this industry, uh, the rural housing project, the urban housing project, infrastructure projects, metro, and real estate residential. 6.5 million houses are to be built under the Pradhan Mantri Awas Yojana. Under the urban housing program of Pradhan Mantri Awas Yojana, around 1 crore houses are to be constructed for urban poor and middle class, with a total investment outlay of 10 lakh crore and government subsidy of 2.5 lakh crore. In terms of infrastructure, budget allocations are of around 11 lakh crore for FY26 towards various infrastructure facilities. Bharatmala Pariyojana, about 50% of the construction is pending out of the total 34,800 kilometers until October 2024. The Pradhan Mantri Gramin Sadak Yojana, again about 45,000 kilometers of road length, is yet to be constructed. The metro projects, where 600 kilometers of metro rail projects are under development. Expected utilization of about 24 million tons of cement is likely to boost demand for this sector again. Residential real estate, we have seen robust launches and absorptions ranging between 2.2 to 3.2 lakh units every year for over last 3 or 4 years, and this trend is likely to continue driving cement demand for FY26. Next slide, please. Amid all this, Uh, our expectation, BWR's expectation of revenue growth for cement industry in FY26 is around 8 to 9%. We expect the FY26 growth to be driven largely by volumes, while realizations have remained more or less stable, with some downward trend seen during later half of FY24 and early part of FY25. There is a bit of recovery which we see in average realization per ton towards the second half of FY25, and this brings it close to the prices which we have seen historically. Although FY26 would not be significantly different in terms of price realization or average realization from here on. Next slide, please. We expect the growth largely to be driven by higher volumes, mainly on account of capacity utilizations. If you look at the capacity utilization of larger players, they have hovered between 70 to 80% as compared to the industry average of about 64 to 65%, indicating their zeal to push volumes to capture market, even if it comes at the cost of realization. Therefore, realizations have remained softer. Next slide, please. The realizations, on the other hand, are likely to remain at best muted, both for the large and the mid-sized players, amid increased competition to grow market share in existing market and to penetrate new markets. Realization per bag of overall market is now has now turned flat and is likely to continue in the same trajectory in FY26. We now dwell into the cost component of the industry, that is power and fuel and logistics. Both these components constitute anywhere between 22 to 28% of sales value, and are the most important cost components to determine industry's profitability. Next slide, please. If you look at figure 10 and 11, they provide a comparison of power and fuel costs of large and mid-sized players across geographies. While per ton power and fuel costs for large players has ranged between 1100 to 1200 rupees over the last few years, it has a broader range of 1100 to 1600 per ton for smaller players, reflecting their susceptibility to volatile raw material prices and limited ability to, to negotiate prices or control cost through efficiency improvements. Figure 12 also captures the pet coke prices, which is a key fuel and source of energy for the industry. We notice that pet coke prices are on the rise in FY20 fourth quarter of FY25. Global uncertainties are likely to impact pet coke prices as well going forward, and the ability to manage this volatility will enable the industry to protect margins. Next slide, please. In this slide, we dive deeper to understand the efficiency parameters of industry which drive power and fuel cost. Thermal energy for the kiln and electricity consumption for crushing clinker to make cement are the key components of power and fuel, and larger players have demonstrated stability in these two parameters. Thermal energy consumption has improved to below 750 kilocal per kg of clinker for most of the large players, owing to their investment in energy efficiency and waste heat recovery systems. Their electricity consumption per ton has remained around 74 to 75 kilowatt hour per ton. For the smaller players, these corresponding numbers are around 80 to 85 kilowatt hour per ton of cement and 750 to 780 kcal per kg of clinker. Next slide, please. Similarly, logistics cost for most of the large players is around 1200 to 1400 per ton until FY24, and has shown some improvement during 9 months FY25 owing to channel efficiencies built in during the recent years as a result of acquisition and capacities in new geography closer to the consumption market. While smaller players face the challenge of increasing logistics cost owing to underutilization of the logistics capacity or attempting to penetrate distant market to achieve volume amid competition from larger players. Next slide, please. These cost components drive the margins of the industry. EBITDA per ton of the larger players has remained in the range of 900 to 1300 per ton, depending on the product mix, while that of the smaller and mid-sized players range between 600 to 1100 per ton during the same period. We expect that this difference is likely to continue going forward. This is also one of the key considerations in determining business strength during a grade rating exercise. Margins of the industry have come under pressure amid softer pricing and increasing cost. The pressure is higher on the mid-sized players owing to higher per ton cost as discussed in earlier slides, along with fixed cost inflation related to operations and inability to pass on higher cost due to competition. Margins of the larger players have softened from the 20 to 25% zone until FY25 to sub 20 levels in FY24 in 9 months FY25, while smaller players have seen margins decline to below 10% from higher teens until FY22. Next slide, please. In terms of balance sheet strength, most of the large companies have a healthy and unlevered balance sheet. The TOL TNW is hardly 0.5x. The leverage levels are around or below 1x. The interest cover remains or continues to remain in double digits, indicating comfortable debt service ability. While in case of smaller companies, next slide please, the balance sheet appears to be relatively weaker. Their TOL TNW is above 1x and almost double that of the larger entities. The interest cover has moderated to lower single digits and their leverage remains elevated at around 4x, indicating relatively weaker credit profiles. Larger companies, due to their healthy balance sheets and cash generating ability, are more comfortable incurring expansion capex or targeted acquisitions. I would now pass on to Vikrant to speak about the key capex initiatives and M&A developments in the industry. Over to you, Vikrant.
Thank you, Neeraj sir. We will now discuss the recent developments and trends in capex for the Indian cement industry. In this segment, we will take a closer look at the different regions in India and the key players driving capacity expansions. Beginning with the North Zone, where Ultratech Cement, Shree Cement, and Ambuja Cement are the key players. Ultratech Cement has recently announced a new 3.5 million tons per annum clinker unit in Rajasthan. This project has an investment of 1500 crore rupees. On the other hand, Shree Cement commissioned a remarkable 3 MTPA clinker unit in Rajasthan, substantially boosting the capacity in this region. Another 2 MTPA grinding unit in Haryana is planned for commissioning in the fourth quarter of FY26. Moving to the West Zone, where Ultratech Cement, Ambuja Cement, and ACC Limited dominate. Ultratech Cement's latest accomplishments include expanding their Gujarat unit by 1.8 MTPA in Q4 FY24. Ambuja Cement, on the other hand, has set aside a substantial investment of 1200 crore rupees for a 2 MTPA clinker line in Maharashtra, expected to be completed by FY26. Additionally, ACC Limited is geared up to set up a 1.6 MTPA grinding unit in Gujarat, anticipated to be operational by Q2 FY26. The South Zone, where Ramco Cement, India Cement, and Penna Cement are at the forefront. Ramco Cement recently added a remarkable 2 MTPA clinker unit in Andhra Pradesh, thus expanding their capability in Q2 FY25. Penna Cement, on the other hand, has committed 2,000 crore for a brand new greenfield plant in Telangana, boasting an impressive capacity of 3.5 MTPA. Ramco Cement plans to commission an additional 2.5 MTPA grinding unit in Tamil Nadu by the third quarter of FY26. Lastly, the East Zone, where Dalmia Bharat, Shree Cement, and Star Cement are the leading players. Dalmia Bharat has recently completed a 2.9 MTPA clinker unit in Odisha, unveiling their plans in Q3 FY25. Meanwhile, Star Cement expanded its grinding capacity in West Bengal by 1.5 MTPA in Q1 FY25, marking a significant milestone for the company. Dalmia Bharatin is investing a substantial amount of 1,800 crore rupees to add a 3 MTPA unit in Jharkhand, expected to be operational by Q4 FY26. The Indian cement is witnessing an exciting era of expansion, with a projected investment of 1.25 trillion rupees to increase capacity by 130 million tons in the upcoming fiscal years of 2025 and 2026. The cement industry is experiencing a wave of growth and development. The larger players, with their healthy credit profiles, are seizing the opportunity to incur debt funded capital expenditure, enhancing capacity and efficiency. In the dynamic Indian cement sector, mergers and acquisitions are playing a crucial role in driving market dominance and achieving economies of scale, with several key acquisitions shaping the industry landscape in recent years. The Adani Group's acquisition of Ambuja Cement and ACC from Holcim for an amount of $10.5 billion is indeed a game changer. This deal solidifies the Adani Group's position as a major player in the cement industry. It also leverages the synergies between the companies, enhancing the market reach and operational efficiencies. On the other hand, the Ambuja Cement's acquisition of a 47% stake in Orient Cement for $451 million is a strategic move to strengthen their market position. By expanding their stake in other cement companies, Ambuja Cement is ensuring greater competitiveness in the market and establishing themselves as a key player. The merger of Penna Cement and Sanghi Industries is a significant step towards improving operational efficiency. Dalmia Bharat's acquisition of Jayaprakash Associates Cement assets for $687 million expands their presence in the cement industry and provides them with a larger market share. This deal enhances their resources and capabilities, positioning them for further growth and market dominance. UltraTech Cement's acquisition of Kesoram Industries cement assets for 7,600 crore expands their production capacity and solidifies hold in the industry. By expanding their footprints, UltraTech is better positioned to cater to the increasing construction demand and capture a larger market share. Let us look at the other key acquisitions in the Indian cement industry over the past couple of years that highlight the sector's trend towards consolidation. UltraTech Cement, a name synonymous with growth and strategic expansions, also made their mark. Their acquisition of India Cements with a $472 million investment solidified their presence in the southern region, bringing them step closer to achieving their goals. Dalmia Bharat, with a vision of becoming an industry powerhouse, has set aside targets for itself. Through a combination of acquisitions and organic growth, they aim to achieve an installed capacity of 110 to 130 million tons per annum by 2031. Andhra Cements felt the ripple effect of the industry's consolidation push when Saga Cement took over the company in a significant deal worth 9.2 billion. This move allowed Saga Cement to expand its regional influence and strengthen its position. These acquisitions speak volumes about the sector's desire to optimize operations, expand their geographical reach, and stay competitive in an ever demanding market. These strategic moves have been funded through a mix of debt and internal accruals. The industry has witnessed the deal at an average cost of 90 to 120 per ton, a figure that reflects the replacement cost and ensures a sustainable financial structure. The industry is poised to witness even more exciting developments as the company strives to shape the future and cement their position. Now, for the concluding slides, I would like to invite Neeraj sir to present them.
Yeah, just display, Vikrant, we would just display the slide, yeah, consolidation phase for a half a minute and then move to consolidation. To the concluding slide, we'll move to the concluding slide in half a minute. Yeah. Okay, to conclude, the broader trends, industry growth largely will be driven by volumes more than pricing going forward in FY26. Pressures are here to stay, but will be more pronounced for the smaller players. Larger players are better placed and equipped to manage cost due to their investment in efficiencies in the recent past, and mostly in key cost components such as power and fuel through WHRS, etc., and logistics through better market reach. Margins and credit profile of the smaller players will relatively weaken going forward as they face stiff competition from the larger players to maintain their market share as well as pricing. On the other hand, larger players' strong credit profile will enable them to invest more in efficiency, greenfield capacity, and acquisitions, unlike their smaller counterparts. And if you look at the next slide, how has the rating universe behaved for the industry? Figure 26 indicates that the investment grade rating space is sinking, while that of the sub-investment grade is on the rise, more so during second half of FY25. Mid-sized companies face rating pressure, and if you see figure 27, downgrades have outpaced upgrades during second half of FY23 and whole of FY24. This was the period when the cost component rose significantly, mainly the power and fuel cost, and therefore, the ability or the kilowatt kcal per kg of clinker was higher. That is the thermal energy consumption or the cost of power, and again, this is raising during the second half of FY25. The downgrades, they are on a rise in second half of FY25. Most of these downgrades would be in the mid-size space, while larger players will continue to enjoy a very stable credit profile, and therefore you won't see a lot of rating action, more negative rating action, more so to be very specific for the larger players, while smaller players and the borderline investment grade players might see their rating undergo a downgrade if these cost pressures continue while realizations remain soft. With this, we conclude this presentation, but we would take some of the questions which we have received during the registration. Uh, so, Vikrant, the question to you is what is the role of cement in sustainability, and are alternative to cement the future for dependent industries in India?
Sure, sir. Thank you, sir. Cement plays a dual role in sustainability. While its production contributes 8% of global CO2 emissions, it remains indispensable for infrastructure development. In India, the second largest cement producer, the industry has adopted measures like blended cements using fly ash and slag and alternative fuels, biomass, municipal waste to reduce emissions, achieving the lowest carbon footprint globally. Initiatives like carbon capture and renewable energy integration further aligns with India's 2070 net zero targets. However, alternatives are gaining traction to address residual environmental impacts. Ashcrete, hempcrete, and geopolymer concrete offer 30 to 80% lower emissions than traditional cement. Bamboo and recycled materials also serve as a sustainable substitute for specific applications. While cement will remain critical for India's urbanization, a hybrid approach combining low carbon cement innovations with alternative materials is likely to define the future of construction, balancing growth and environmental goals.
We have one more question in our chat section. Uh, it says, how will the recent tariff dispute in global economy impact the cement sector? Okay, I'll take that up. Cement, by and large, is a commodity which is consumed, produced and consumed in India. At 4 rupees or 5 rupees kg, you don't, really export cement to anywhere except for the neighboring countries. Very small portion of this gets exported to nations like Sri Lanka, maybe Bangladesh and Bhutan, Nepal. But by and large, cement is a domestic story, immune from this ongoing tariff disputes. Pet coke, that's a global commodity again, but India is more or less dependent on imports. So, and these imports happen largely from the Middle Eastern countries. So, the tariff disputes won't really impact either the incoming raw material, nor would they have any impact on the cement prices or the end product, which are mostly domestically consumed. There is another question with Adani's acquiring ACC in Gujarat, Ambuja, and Aditya Birla Group, Ultratech Cement expanding rapidly in capacity and geography. Are we seeing a oligopoly in this market? What happens to the smaller players? The smaller players will continue to face the heat. They are already squeezed for margins. We see that larger players are actually attempting to, flood the markets. The capacity utilizations of these larger players have, reached that 80% odd, which is, which has not happened any time in the past. I mean, every time it happened in the past, cement prices crash, and many of these smaller players start making losses. And we have seen this kind of cycle sometime during 2012 to 2014-15 period, when cement the supply side discipline was broken, and therefore many of the smaller size players started making losses because they are not very or really cost efficient in terms of at a lower scale. So if prices are something which get impacted by this higher one penetration from the larger players and capacity utilization of these larger players, smaller players will suffer both in terms of margins as well as their credit profile. And that is the reason why we see a lot of these smaller players finally selling it to the larger players. We have seen Sangi being acquired by Adani. We have seen Penna, which is under acquisition currently by Adani. Adani has also acquired one of My Home's cement plant in Tuticorin. Likewise, the other players are also moving. India Cements, again, if you look at India Cements, it was one of those leading players in South India, has incurred losses in FY23. FY24 was not so great. So India Cements is also struggling, and that is why there is a acquisition news on India Cements as well. One of these large entities has acquired. Yes, so we are moving towards that consolidation phase, and if this continues, then of course we will be left with very few large players. Although it is not still a oligopoly market. I mean, there are quite a few players. For example, Shri Cement, Dalmia Bharat, Adani, Ultratech, of course. And then again, cement is more or less a local story. Many of these, brands are very, very local. So we will not see a erosion of these brand names, at least in the rural or the local economy. But yes, there will be attempts to acquire, and we are moving towards that consolidation where we will have five or six large players who will dominate. As it is, more than 50% of the capacity is controlled and operated by these large players. So yes, we are already almost there. Perhaps yes, this would only increase going forward. So I don't have any further questions in my queue, Vikrant, so to say. So
Sure, sir.
we can, if there are no further questions forthcoming, then we can wind this up. Vikrant, in case you have any closing remarks.
No, sir, I think we have covered most of it. I think we can wind up the presentation, and I hope we see your participation in the forthcoming events as well. Thank you so much.
Thank you everyone for your time and see you in the next presentation.